Okay, here we go. Okay. Sorry for the late start. So while I'd like to give it a few minutes after I tweet out the link to give some people an opportunity to come into the room. So while we're doing that, if you give me some topics you want me to cover, I will do my best to hit on them. So fire away here. Let's see what you got. Welcome. First day on Periscope there for Josh. Nice. Okay. Just writing down what everyone's messaging, and we'll see what we can get into here. All right, I think we have a good amount here, so all bets off, as we would say. I think we can cover a lot of this stuff. So we had the Fed Beige book today, really rather uneventful. I mean, I don't know how these people do these, write these statements anymore and keep a straight face. The economy's getting better, but it isn't, but it is, we're just kidding. It's sort of a lot of double speak. There was, however, an interesting bid out today from the Atlanta Fed, and they lowered their GDP forecast. I was hoping to have that pulled up. Yeah, they went from 2.4 from 3.0 the last time, and for some reason I don't have that tweet. I thought I had it up. I guess it got knocked out. Anyway, they lowered their forecast. I'll cover that more in the weekend review if I can't seem to find it during this video, which is really rather frustrating. I thought we'd have it, but no biggie. Here it is. So yeah, they lowered it. They lowered it to the Q4 GDP to 2.4%, down from 3.6. That's a pretty big cut. It makes you kind of wonder why the Fed is even discussing raising interest rates. Anyway, with regard to interest rates, they have been rising in TLT terms, and this is all what's very important to the market. We are, as I've discussed in the weekend review video, at a key point. We're at a pause point, actually. I had drawn in over the last few weeks some I guess sort of my version of red light, green light, 1, 2, 3. I drew in the red light, the yellow light, and the green, and we're currently kind of moonlighting in the yellow light area. So this like 119 to 120 area is very key. We did get a bit of a bounce today. Let's try and zoom in. Getting much better at this with the new chart system. But we didn't quite recapture. We're still making lower lows and lower highs. So until that pattern changes, we have to assume that the trend is still lower for TLT. Some big levels are just below us that I think a lot of people have been waiting for, including this guy. 117.39 is the 61.8. 100% retracement along with the trend touch is 114.88. So that to me seems like the downside potential. I've been saying for a while, I think that the Fed statement, which is the end, I guess, closer to the in a couple of weeks from now, I think that the market, one, could maybe list sideways until the Fed decision, work off some of this excess that we've had, I guess the run off the lows, give the major moving averages a chance to catch up a little back and fill, if you will. Today there was a S&P rebalance, I believe, and I think that was what caused a lot of the trepidation today, particularly toward the end of the day. And I think that the Fed decision, and this is my working hypothesis, it could turn out to not be correct, but we have a couple of weeks to go from there, and price does matter. But I'm thinking that the TLT will bottom on the Fed, and that the dollar may have an interim top on the Fed. meaning the reason for it's sort of like the earnings. That's the case. So I think that the Fed will mark the kind of the high water mark for the interest rates, or the low in the TLT, and the same situation will be for maybe for the dollar as well. We'll get into that at the time. Anyway, what this rising interest rate has done is kind of wreaked. It's picked winners and losers. The winners have been the banks and the insurance companies that benefit from an increase in interest rates, and the losers have been high-flying tech stocks that require PE multiple expansion to go ever higher. When interest rates go up and their business isn't improving, think about this: higher interest rates are big top line and bottom line boosts for the banks and the insurance companies. They are not the case for tech stocks. Higher dollar hurts their earnings overseas, and the higher interest rate lowers the PE multiple and increases the weighted average cost of capital. We've discussed that in prior videos. So that's the reason why you've had this rotation, and it's been pretty violent at times, out of these tech names into, banks and cyclicals and so on and so forth, because it's the expectation of an upswing in the business cycle. A little bit more on that. The FANG names, the Facebooks, the Amazons, the Netflix, the Googles, have been the only game in town for years. Now that there's a whiff of growth, money is coming out of those names and diversifying into other names. You're starting to get a broadening of the breadth. That isn't necessarily a bearish thing. It's actually a bullish thing. So I take that as a net positive. The major market indices, let's get those out of the way. So let's start out with the VIX first and foremost, because that's sort of the where we are in the range. The VIX is at the lower end of the range, and it's kind of trying to find some footing down here. Today's low was slightly higher than the range low, the last swing low, which was 1216. Today's low was 1223. Maybe we get a little bit of an uptick. I don't necessarily think we're going to get a huge volatility expansion, but I wouldn't be surprised to see 15s at the very least. I mean, that's sort of where the 50, the 200, and the 20 all are. So that seems to me like that could be in the cards in the coming weeks, even maybe the coming days. All right, so that's my take on the VIX. We're in pure directional mode here. So if you're playing things bullishly, you probably want to be buying premium. If you're playing short, you want to probably be buying premium as well. So that's my take. And when I say buying premium, meaning buy calls, buy puts, buy spreads, you don't really want to be selling that premium. I don't really trade the VIX directly. I've found that it's really not profitable, meaning buying calls or so on and so forth at the lower end of the VIX range, because the amount of premium you wind up paying, you really need an outsized move to make money in that. So what I've found most useful is using the VIX range to gauge my trade in the S&P 500, particularly in SPY, whether I'm buying premium or selling premium. So that's the deal with regard to VIX. With regard to SPY, let's start out with the major market. The S&P today had a bit of a look above and fail with this thing ran up today. We opened up rather strongly on the back of the higher oil, which I'm going to get to in a moment. And you had a bit of a sell-off during the day. It started out with a liquidation break. So there's some good news and there's some not so great news. The good news, forever the optimist, is that the high of the move happened pre-market. Usually for the end of a move, an upswing, to occur, a good high is what it's called, it has to take place during regular trading hours, meaning 9:30 a.m. to 4 in the afternoon. And the high today in in SPY terms happened right before the market opened, about a half hour earlier at around 9 a.m. So there isn't an RTH high that is higher than a pre-market. So that's the good news, meaning that we probably haven't seen the high for the move. The bad news is just that we had that kind of look above, and today felt a little bit shaky. Like I said, there was a bit of an S&P rebalance, so I'm not willing to make. And we're still, listen, we're well above the breakout high of 219.60. We're still above the 10-day moving average. We're above that megaphone that I had drawn in the upper beam of the megaphone. So there's really not all that much to be too worried about at the moment. However, you now have, after the breakout, including the breakout, or after the breakout day of 6 days of consolidation. If we start getting below the breakout here of 219.60, we may start pulling back still further. So I'm sort of okay if you're long, if you're going to use that 219.60 area as a stop. The kind of the margin of buffer that I'd be willing to give to that is to like 218.31. Between here and there, the pullback to me is still kind of just, I don't want to say ephemeral because it is decent amounts of points, but it's nothing to really be too concerned about because that was really the breakout of the consolidation above the 217.53 to, really above 217s, 218s. So the 217s. Anything above there to me still remains major bull mode. If we were to have a pullback, I think the first and foremost logical area would be to the, a more serious pullback would be more to the 50 MA. I'm just looking at the chart. That had really been the kind of the resistance when it was rolling over a bit. Now you have an upward swinging 50 MA, an upward swinging 100 MA, and the 20 MA is playing a little bit of catch up. So that to me would sort of be the max downside if we do wind up getting that breakdown back below the breakout point. But we could just do something like we did for, what was this? This was in August to September, where we just chop sideways. And it's possible that that could just happen for the next couple of weeks ahead of the Fed decision. I think what's going to happen is that I don't think that there's worry about the Fed decision. I think it's obvious at this point that we know the Fed is going to hike. It's basically, I don't think there's ever been something more certain than the fact that the Fed is going to hike in December. The probability right now, as far as the FOMC hike, and this is very important, by the way, is 94%. I mean, so that's basically a done deal here. The interesting piece to me, and this is why I think the market isn't spooked about the Fed hike, is that if you look in the next following months, the probability of an additional Fed hike is very low. Like in February, it's only 7.2%. In March, it's 14%. In May, it's 20.9%. In June, it's 43.8%. In July, same thing, 43%. September, 43%, basically 43%. And even so basically, it's sort of like the market is only pricing in a one and done again. Like it last year, remember when the Fed hiked and there was that big drawdown in the market, the Fed said that they were planning on hiking 3 or 4 times this year. They're going to hike maybe once in December. So that's the key, the guidance with the Fed. So regardless of that, there might be a little bit of anxiety into where the guidance might be, and we may have a situation here where the market chops, or maybe there's a little bit of a pull down, and then after the Fed decision, we get the resolution to the upside. So we're kind of in a window here where there's, I guess, not that much going on with regard to the upward catalysts here, maybe unless there's some policy decision. So that's where I think we're in that window here where we're kind of in digestion mode. If you put a Fibonacci retracement on the entire move, by the way, from the low, the 200 MA test to the recent high, the 50% fib and that would be a pretty big move, would be to 215s. So that area to me, and that's, by the way, the consolidation low, remember what I had talked about, that to me is sort of like the max downside with regard to IWM. And by the way, we may not see that. With regard to IWM, this got my price target. We got the 132.68, which is the 1.618 Fibonacci extension of the range. It even went a little bit further. I often notice with some of my technical work, it's sometimes usually to the tick, or sometimes it overshoots slightly, and then it winds up eventually coming back through it anyway. So my thinking here is today we closed just below the 10-day MA. The real breakout here was the 129.10. So until we get even anywhere below that, I mean, it's hard to say that IWM is really bearish. I do think, though, that we could pull back and retest that breakout. If that's a good point for a right or right out long. If that fails, I'm going to start thinking put ratios or maybe even spreads down to the 125.88, because that was the real range breakout of the consolidation. Yeah. If this, I'll tell you another scenario which people may find interesting, and this is going to be my trade setup here for IWM. You have 3 days now of basically selling and consolidation after a run-up of 1, 2, 3, 4, 5, 6, 7, 8, 9, 12, 13, 14, 15 days after the gap. I'll tell you also, statistically speaking, and I think I mentioned this in the weekend review video, that if you I know I've mentioned this before, if you throw, let's say, 100 coins in the air, roughly 50% of them will be heads and roughly 50% of them will be tails. Once in a while, you'll get groupings of all heads or all tails. Statistically, it's rarely, almost never possible to be more than 15. So this, to me, was the kind of the extreme of that move. And we got our fib extension that we were looking at. So I'm thinking that we could have a few more days of pullback in IWM. If you're playing it short, I know a lot of people are. Listen, I like to play it. I'm just reading some of the comments people are posting. I'll tell you this. I usually, when things are in trending mode, I like to either, if it's a declining market, short the rip. If it's a rallying market, buy the dip. I know a lot of people are looking to pick tops here, though. 133.09. If it gets back up above there, you don't want to be short. That's the last 2 days. You have double tops there. If you, like, let's say tomorrow we get back up through there, just do not be short. Is my thesis, because there is room, like I talked about in the weekend review video, to the channel high, which could be anywhere by the time you get there of 137s, 138s. So I'm thinking the 2-day high, the consolidation high of 133.09 is your stop. Your target here to me would be 129.10. Trim and trail there and use maybe some stops on the trailing basis. And then 125.88 would be really a big decision point if it were to get back there, because that's the big breakout, and it'll probably be the channel low. So that area, I'd be into selling out of the money puts or buying. I love the idea of playing put ratios, meaning like buy the 129s or 130s and selling 2 times out of the money of like 125s, 126s. I think that would make a heck of a lot of sense to me for IWM. We covered that sucker. The Qs, like I said, haven't really been participating so much because of the weakness in the NASDAQ 100. Today, though, you did get a bit of a close below the 50 MA. The highs in there are poor. There's really nothing to get too crazily bearish about unless you start closing back below the 115.75. I know we've had a few instances where we've been down there, but it hasn't felt comfortable. It hasn't spent a lot of time. You also have a trend line touch at the last reference low of 113, basically at 113.45. So if you're playing, like if you're looking to put on protection or you're looking to play spreads, like let's say you're long FANG names but you want protection, you know, you could always buy a Qs you can buy a Q's put spread and play it like that for a move basically back. We got to the higher end of the Q range, and the lower end has been in these 113s. I don't know if it would hold again if we got back down there, but that is trend, and that is a big area. So that's my thinking with Qs. I think it's just a wait and see until you can break the range. If you get back up above the 119.66 area, I think it's a long. Right now we're in the middle, so there's not much doing, and if you could start breaking the 113s, 113 halves, 113.45s, then the move is probably more to the short side. I will caution this: if you get to that area like straight in a couple of days, you'll have been coming down from the bottom. Coming down from the top right to the bottom of the range, and even if there's a break, it might not last. What you'd want to see really for that short to kick in is to come down, spend some time down there without the rally, like a few days, and then resolve to the downside. If it comes down in like a straight line, hard and fast, it's probably even more of a theory to sell like the out of the money puts. So we covered that. Apple, speaking of Qs, it's hard to cover the markets without Apple. This is one I've been watching really closely. It's just been consolidating in range. You had kind of a decline. You got a 50% fib bounce. You got a rally back up to like sort of the reference breakout of the 112.39. So if you're not in Apple, I would wait for it to clear that 112.39 in the 50 MA before really, loading up long. If you're already in it or you're looking to initiate a short, it really shouldn't see below 110 again. You're basically hugging the 20 MA. You have a 109.43 of the 100 MA. The 100 MA was a lot of resistance on the breakout, and it kind of has held. So if you're long, I think 100 MA is an okay area, or if you want to initiate a short, a break of the 100 MA. I'll tell you this also, I've been getting a lot of DMs. I get a lot in general, and I want to just, this is more of a fundamental type of I'm answering about how people are trading. I'm noticing on days that are very minor pullbacks or even very minor up days, people who are positioned off sides are getting their heads handed to them. And I think that it has to do, I've read through a number of these DMs and probably have a sample size of about maybe a dozen or more that I'm referring to with regard to this email. With regard to this conversation. And I think it has to do with people trying to force the market to pay them and trading out of season. Meaning you need to have a number of factors in your favor to trade in size. And I'll tell you, even from personal experience, when I was trading, particularly with a smaller account, I was always looking to be at max margin. If I wasn't at max margin, I felt I was missing out on something, right? I mean, the gains were good, but they should have been amazing, and I'm not trading for for a couple of little, bucks here. I'm looking to make big money. You can do that at times, and I'll tell you, I've had markets. 2013 was a home run derby. You could have been long, you could have been levered, you could have basically bought, any old thing, and you'd have pretty much been guaranteed money. That isn't the case in the last few years. You've worked off, there was a 30% move. I've heard a lot of people say that the markets average 10% a year or so. Keep in mind that you basically have averaged that out now. You've basically averaged out your 10% a year. So I think a lot of people are frustrated and they're trading out of season, and the market is basically, for the most part, it has been range bound. It's first starting to kind of have a little bit of a look above range here. Keep in mind, coming up from the bottom, that's always a little bit harder to sustain a breakout. So the back and fill and the chop is very natural and normal. But I think that they're overly long or over in size that is bigger than they should be in positions, because they're looking to force the market to pay them. And those are some of the most costly mistakes I think people can make with regard to trading. So just keep that in mind when you're trading. Keep your size right. Also, trade location. I'm noticing people are not entering trades or exiting trades well. That's always important. If you kind of buy right, you sit tight, or short right, sit tight. You're letting little intraday moves. You're watching the tape. You're watching the sausage be made, and it's shaking you out of positions. I'll tell you though, another big mistake that I'm noticing. This is again part of the email series that I'm discussing. That people enter a trade and they don't necessarily use the proper risk management. Like, for example, I had a trade today that I tested the waters in Lululemon. It had been in a multi-day consolidation range, and it broke out of the range and very quickly came very back in, and it closed pretty poorly. That, to me, was already a stop out. I didn't really want to wait and see what tomorrow brought. Maybe it'll rally, maybe it won't. But the point is my trade was for the breakout of range. Once it came back into range, my thesis, the reason to put on the trade, is now over. If you have a trade that you put on, and I'll tell you, I almost went out today short the stock, but I would probably do that on a break of low of day tomorrow, because now that you failed, by the way, on Lululemon to make the break out of the upper end of the range, it could traverse to the lower end of the range. My theory, my thesis, was if it broke out, I thought it was going to have a short squeeze ahead of the earnings. Now that it came back in, now I'm thinking maybe it has a sell-off ahead of the earnings, particularly with like Guess and all this garbage reporting after hours that didn't do well. So that would be a trade setup that I'd be looking for, by the way, tomorrow, which would be if there's a violation of the low of day of today's, maybe to initiate short. That would also be below the 10-day and the 20-day, maybe for a move even as close down to as 54s. So that's sort of what I notice. I know people will get into something, and then they'll sort of hope and pray, or that it'll go against them, and they don't know when to take the loss right away. The minute your thesis, or when you immediately think it's going to go lower, like I was talking to somebody about Facebook actually in some detail, and if you remember, I've been very bullish on Facebook really since $20. And I never have looked back other than a few trading opportunities where I've discussed pullbacks. I'm getting a little squeamish on the name for a few reasons. One, they have the currency going against them, and we know in the past when Facebook has had problems on quarterly earnings, the currency has been against them. Two, the FANG names are out of favor because there's the broadening into the materials and the energy stocks, the cyclical type of names, and the banks. And thirdly, they reported a quarter and they basically said that their growth is slowing. That is not a good recipe for higher stock prices. As well as this stock is so heavily owned, I shouldn't say everyone, but a lot of people I know, their biggest positions are Facebook. They hated it, by the way, at $20, and now they had to have it, and it was going to the sky. And I had said that 128s and 130s were the spot to book it. It got 133s, again, pushed through my level. But if you sold up there, you're probably very happy because the stock at a minimum is $10 lower and looking rather shitty technically. So let's discuss Facebook. That's one that, again, that's widely held here. You had a breakout bar day that was on the 11-21, which I was saying starting to look like a one-day wonder, and I'm really even starting to think more of that. You have a 61.8 Fibonacci retracement of the recent of the range there. We've already come down here, so I wouldn't put as much weight in that. 117.59 was a past an old peak before new ones, and the low of day of that bar was 117.80. Today's low of day was 117.95. So if you start losing that bar, that low of day, I think you'll easily see the 113s again, potentially even down to the 108s, 109s. Again, this was all risk management discipline. We're still caught up. There was one really, really big bar day. That was also on 11:10. We're still caught up in the context of that big bar. So for me, I love those big emotional days, those big range days. When you clear the high of that, of 124.18, then I think the stock is on the road to recovery. Until you clear there, I really am not that interested until this thing kind of can start making, again, the higher highs off higher lows. Right now, we are still making lower highs and lower lows, and it's still to be proven yet that we have a higher swing high. The first sign of that, again, would be, I think in stages, would be over 122.98. And then really to begin a more sustainable repair of 124.18. And until I see that, it's going to be the same old story. I'm going to be very cautious on this. Let's knock out the banks and the yield stuff all in one shot. I think that stuff, like I said, the bonds and the utilities and all the bond proxies, I think a lot of that stuff may bottom on the Fed hike itself. So conversely, I think that the yield sensitive stuff like the utilities and things like that, some of the REITs that have not done well, the bond proxy equivalents, I think that stuff is all likely going to bottom also with the Fed. The XLU, someone asked about the utilities. This is a head and shoulders breakdown here. We got a 61A to the range. It's trying to kind of repair itself a little bit, but we still have yet to make a higher high on the leg. So I'm a little iffy with this. Like I said, with seeing higher highs and higher lows, I need to see it, and we're now back below where I would construe as a neckline here. There's a couple of ways you can draw it. I'll be the most generous here, 46.73-ish, 46.79. Anything below there to me remains not so hot. Today the last couple days you ran into resistance basically around the 50 MA. So until you start getting back-to-back closes over the 50 MA, I wouldn't play it for a momentum move back higher. However, I would love to see like another couple of like high volume dump days down. I'll tell you the bad news though is that if this really is the head and shoulders pattern here, it's got a ways to go. This thing could even see like 33s maybe. The neckline, you take the measurement from the head to the shoulder and then project that down. I mean, this thing could move. I mean, there's a lot of room. Oddly enough, 34.15 would be the big head and the big 61.8 and the that could happen. I know these are slower movers, but this could just bleed over time, particularly if the Fed is going to be in a rate hike policy. I will say for a trade, I like the idea if this continues to go down into the Fed to sort of buy it as a counter trend trade, because I think it's going to the yield sensitive stuff is going to bottom right when the Fed does the hike, and there will be a period of rally. The same thing with the banks, on the other hand. They may peak short term, at least, on the actual Fed hike. The only way I see the banks rallying into the Fed and then continuing for another leg is if they have some type of pullback first, consolidate sideways for a little while, or the Fed gets really hawkish with their dot plots, meaning that they bring everyone's expectations up of more rate hikes, which seems unlikely because they've already talked about being cautious. So I think that those trades are going to kind of flip the script on that situation. One stock that I've been meaning to discuss, and I just haven't, is this NVIDIA. This thing is like super parabolic. It's just kind of a monster, right? I mean, the stock just kind of knows no bounds. It seems like it wants 100. You have a multi-day consolidation bar, and you had a doji. You've had a lot of dojis at the top of the range, so it looks to me like we're finally getting the pullback in NVIDIA. I wouldn't really be long this anywhere below like 94.79, and I'd probably be interested in getting short below 90.65. you'd be below a lot of days range. Today was your first break in forever, first test and break of the 10-day moving average. So I would not be so keen on chasing this thing up here for the last few points. It could pull back. I think it will eventually resolve a little bit higher, but I do think that it could be in pullback mode here, maybe even to 88s. We'll have to see. Someone asked about IBB. Wow, this thing is not acting well at all. This has just been one of those range trades. Today you stopped dead on the 200-day moving average, so today is the you basically need to hold the 200 or get back above, or else that gap fill down at 263s could loom large. I mean, you're already into the gap range here after having looked into it 5 days ago with a violent response higher, and then today you closed below that low. So I would think that the gap fill is probably in play at this point, unless you can get back up above today's high in the 100 MA. So yeah, that's my spiel with IBB. I'm just looking at some of these other names like Gilead. These things have just, they're not acting well. It's also really, I think the problem with these stocks also is it's late in the year, that there are a lot of losses in these names, and that they're going to there could be some tax loss selling. So be a little careful with stuff like, like Valiance or, Chipotle's, names like these that, I can't see money managers really initiating on, and maybe they want to take some profits in those types of names. Conversely, stocks like NVIDIA are up huge, and there's a lot of profits in those, so I can't really see them, getting, unless there's some kind of great market smackdown, I can't see them pulling the trigger on selling these things really in any size until the end, and then until the end of the year. That's just sort of the mechanics of the money management business, which for a very brief time I was part of. Bank of America is just rocking and rolling. The 1.618 fib extension, I discussed this, is at 2311. It's probably a little late to chase this thing here, but wait until it peaks, then throw a Fibonacci on it, or look for some pullback ranges. This thing probably could pull back to $20 and still be okay. Like if I were long here, as long as to me it was above 2020. I'm sorry. Yeah, above 2020, it to me is still sort of okay. But like I said, this thing is going ballistic here. I would probably not. I think it's safe to say you're probably not the smart money if you're first chasing it here. Goldman Sachs today, this was some move. This could have been a bit of a blow off move in Goldman today, because you had a there's two schools of thought here. One is you have that big up bar day with an expansion in volume, although I would have liked to have seen more volume for that thesis. You, by the way, have negated fully the head and shoulders in Goldman Sachs. Today was a gap and go above the downtrend. So, again, these things are in bull mode, but it's late to chase. I mean, if you're if you must own Goldman Sachs at $220, where were you at $138? At the double bottom, probably at trend, double bottom at trend. So this has moved real far, real fast. Like I said, if you're long, I think you could use probably half of today's range, or even if you've been in it for a while, the whole, the low of day today as a stop. But it's probably prudent up here at the basically at the all-time high. The breakout to me is a little. I like that there were a few days of consolidation, but I'm a little suspicious of the breakout just because it's come up from the bottom so far, so fast into a reference horizontal level. That said, the head and shoulders is negated, and I think it could be now bought on dips. My guess is somewhere down near the 190, closer to like 200. At the very earliest, I'd probably, if it got down there, I'd be looking to maybe sell some near dated out of the money puts. So if this thing though starts consolidating and just going sideways for a while, maybe it can work off some of that excess. Anyway, we've been going for a while here, and I think we, for the most part, covered. Someone had asked me nicely to cover potash, by the way, so I'll do that quickly. This one, I happen to be long. I've been just kind of sitting in it for a while. It's just been ho-hum consolidating. You're getting closer to the high end of the range. You really, for me, I wouldn't add on this thing until it breaks the 119.38 area. That's the tippy top of this range. That could be where we're going, but I'm seeing some things that I like. I see the 200-day moving average bending and starting to arc up. Same thing with the 50, same thing with the 100, the 20. It's looking a little bit better. Yeah, I mean, I'm thinking that this will eventually get back up maybe to the 23s or maybe even 26s at some point. So that's the story on that. Thank you. Somebody reminded. If this, by the way, comes up, it comes back down to sort of the lower end of the range, like in the 14s, then I'm more interested in that. Let's talk quickly about oil. That's one. We'll end on oil. That was sort of the zeitgeist of the day. The oil situation got really got kind of crazy. A lot of people. I did a survey yesterday, and like 70% of the people said they didn't think there was going to be a change in OPEC. I came in actually fairly heavily long oil stocks today, so today could have really been a disaster if it didn't go the right way, but it usually does. So we had this big move up in oil. You had to look above the head and shoulders pattern seems to be negating. The right shoulder high was 49.20. So we're technically below there. So, I mean, you could go sideways and just build out the shoulder. But it seems to me that as long as this now can hold the 50-day MA, it's probably going to go a little higher. You had the Saudis cut, the Russians cut. I'll keep it like that. A move to the 50 MA to me would be buyable. Below there, it's kind of a GTFO, meaning get the F out. But this thing, really, if it can get back above and maintain over 49.20, it's really just a chip shot away from those 52s. And if you get above the 52s, you're probably talking about the next $10 up to 62s. So that's what I'm watching in oil. Personally today, I had some short puts in some names. I closed those because they're near dated, and I rolled them a little bit longer dated in smaller size because of the lower IV. So I booked some profits. I still wanted to keep my my trade on in some of these names. Some of them I just outright own the shares, but like Exxon, for example, I had been short some puts that expire. I rolled them out and just did it in smaller size, I believe. What was I going to look? There was one more. So I lied. There's actually going to be one more that I want to finish on. This Skechers, I took a little nibble on this today because yesterday was a breakdown, and it turned out to be a false breakdown. Today was up really big. I'm fine with being long this as long as it's above 22.25. That with maybe a little room to the 50 MA. But today, basically, it had gotten close to the gap fill, pulled back, and now it filled the gap and now up pretty solidly. So I think if you're in the name, you could be in it as long as the stock continues to stay above 22.25. Anything above the high of day today would be 23.09. I think that this thing could easily see like 25.92 and possibly even threaten up to the 27s. It seems to me like this is trying to build a bit of a base down here and could potentially be an inverse head and shoulders. So I nibbled a little bit today as a right or right out type of a trade, and we'll see how that goes. I'll update if there's any changes. That's my story. I'm sticking to it. If you came to this video late and you want to watch it again, you can see it on my YouTube channel. That is Justin Pulitzer Trades. It will be posted up there shortly. I'm going to do it now and maybe edit out the run to the dishwasher to shut that off. Anyhow, that's my story. I'm sticking to it. I hope you guys and gals enjoyed the video, and have a great rest of the trading week, and cheers.